I thought I've got a bit of a reputation for not really liking central banks, which in some ways is not true. I've had to deal with them often enough. I've been on the board of a number of banks in the city, and I've frequently appeared in front of FSA, PRA, and the Bank of England. And basically, what I was concerned about was I didn't want to get the impression, or give the impression, that I think these institutions are quite as important as we often think they are. So I thought, well, where's a good way of looking at this problem? And I ended up, a typical feature of the way I often lecture here, as any of the students will know, is that I try and contrast something that's happened in the past with something that's happening today. And SVB was happening today, and there were a lot of issues, not just SVB, but Signature Bank, First Republic, etc. And there's a lot more, as you'll see from some of the slides I brought up here. And then, how did that work if you didn't have a central bank? What happens if you don't have a central bank? Is there still a problem? And the answer, of course, is yes, because the problem is basically founded in the way in which economies work. So I took the US crisis of 1907, because there wasn't a central bank in 1907 in the US. There wasn't a central bank until 1913. And basically, there was a huge panic in the markets in 1907 for very good reasons, let me say. First of all, there was the 1906 San Francisco earthquake, which was a pretty big event. That was followed by a notable short squeeze in the copper markets, which was a massive scandal at the time. Makes the Bankman-Freud issues look pretty small, and a huge collapse in that market. There was, just for good measure, there was a lot of cross-holdings of reserves. Banks, different kinds of banks, held reserves with each other. So it was an incredibly interconnected system. And a whole set of banks, which we today will call MBFIs, but then were known as trust companies, Bankers Trust is a good example, a whole host of trust companies didn't actually have any way of collectively addressing any liquidity squeeze, whereas some of the other banks did. And all of these banks basically ended up holding a lot of their reserves with the money centre banks, who were very big players in equity markets. So you've got a connection between equity markets as well. So you've got this very interconnected system. Now, there were a few other things going on. There was a huge collapse of one of US Steel's big competitors, Tennessee Coal and Iron. This was one of the things is to picture America in this stage. America had gone through over a decade of 7% annual growth. This economy was motoring like never before, and probably never since. It was motoring at an enormous, well, except in the Second World War, it's an enormous pace. And just to put a cap on it, New York City nearly went bankrupt. So a whole host of shocks to the system. So that gives us a pretty good, pretty good parallel with today. There's plenty of shocks going on. A lot of people here, will give excuses such as, we're suffering terrible shocks today, like the war in Ukraine or COVID. But there was plenty going on in America in those days that would, certainly be highly competitive with it. And these are some of the outturns. Commodities fell on average by 21%. US imports fell 26%, etc., etc. So you get this big panic building up. And it was what is a highly connected system. So there was a lot of, not only was a huge interconnection of this, but there was a lack of deposit insurance, of course, because we hadn't got deposit insurance at all in those days. And there was a lot of asymmetric information. One of the things about this, whenever you hear about this in history, is you're going to hear about JP Morgan, because he dominates the whole scene of American banking at this stage. And what was gripping the markets was something that I certainly learned when I first entered the dealing room, because one of my bosses in those days said, Well, don't forget, he who panics first panics best. So I always remembered that one. I grew up through dealing rooms. Whilst I was treasurer of Barclays Bank Retail, and that's what people remember me in the sense for retail operations across the group, actually most people in Barclays would know me as head of structured products and then previously head of financial engineering in the dealing room. So I was basically running the quant dealing operations. Though basically this asymmetric information plays a role, yes, sure it does. And the one thing that I would focus on though is not so much the asymmetric information as this connectedness of the system. So, okay, so what that leads me to is the lectures that I give at the university on basically network theory, which is where what we're looking at is the way in which systems interconnect with, or systems interconnect. And financial systems are complex, and the interconnections between them are also extremely poorly understood in many instances. And network theory, but network theory and the power of network theory can be appreciated from looking at some diagrams. Let's look at a very simple contagion diagram. This is an oversimplification. We use much more sophisticated ones on the course, but let's have a look at that. And what we've got here is you can see that we have one node in the system goes down, nothing much happens. There's no interconnections between these two systems. We've got two systems here. So you can think of this as linking the securities system to the banking system in the US in 1907. And here what happens is we stick a couple of connections in and all hell breaks loose. As I say, purely illustrative, but it's an important concept. So as these nodes collapse, they, we can't just look at them as nodes as the basis of them looking at each node in itself. We have to look at its connections to all the other nodes. We have to understand how the system is connected. If we're going to give some... Now, nobody's ever going to understand this perfectly. There's been lots of diagrams now being created, but it is beginning to have an effect on the way in which people think, and particularly the Fed. I'll come to that in a moment. These network effects are basically often characterised, I think completely incorrectly by the way, as if what we're looking at are basically fat-tailed distributions, and we're not. I always characterise it on this as fat and fatter tails. What you get is an endogenous process overtaking an exogenous shock. So the shock starts something off, but then an endogenous process takes over. If we were going through the master's courses, what you'll be looking at are diagrams of dynamic conditional correlation between different markets. And what you will see from that is that they change signs. So it's not just the quantities change. It is that if you are holding a particular position here and you've got it hedged over here, the right kind of shock happens, endogenous forces take over, and these two merge into one very big position. Trying to stop that happening by trying to hedge against it is just about impossible. The system becomes extremely dangerous and extremely stressed. So we might use power laws to look at these things, but actually it's much worse than that. In 1907, JP Morgan saw what the problem was, or at least the way he saw the problem in those days, and I think he was quite right, was that basically a whole section of the banking system had nowhere to go. It had no mutual support mechanism, and that was the trust companies. And one huge one, called the Knickerbocker Trust, had already gone bust in a big way. And this was beginning to cause a cascading effect. He decides to, I mean the story is, and apparently it's true, he decided that the best way to get these guys together was to get them into his office, which he did, lock them in and leave them there all night until they actually agreed to do what he said they should do. And it worked. And it did kind of, in many ways, it saved that part of the day. And you can argue at that point that JP Morgan, or JP Morgan the bank as it was in those days, had become a central bank by default. Now, that's an interesting little story, and it leads to the Federal being set up. But the Federal Reserve was set up with two very good, in my view, very good objectives in mind. One was managing the money supply, and the other one was acting as a lender of last resort to the banking system. So basically, they are focusing on money and its creation. And they basically look at the health of the banking system and its connection to the macroeconomy, or the economy in which it operates. And that seems to me to be the basis of any, or should be one of the bases of any central bank. And this connection between the banking system and central banking objectives, or stability of the economy, is something that I think is where we're beginning to get, well, we've gone and got lost. We end up with a dual mandate which says price stability and full employment, and through this structure, basically you implicitly end up with a monetary policy committee and a financial stability committee. And these two committees are separate. And so what you've got is somebody setting interest rates over here and somebody looking at the banking system over here. And of course, the transmission of this, through this, is fundamental to what's going to happen. This can only be transmitted through that. Money supply isn't going to happen unless you involve the banking system, or at least in major part it's not going to happen unless you involve the banking system. And I loved the quote actually from Mervyn King, because if somebody brought that to me, I was thinking, well, the one thing I would have done is write across it root cause analysis, question mark, and sent it back. When you think about it, what he was saying was that somehow we get into a room and decide not to lend anybody any money. It's called an ALCO, Asset and Liability Management Committee. That's the room. We get into a room and we decide not to lend anybody any money. But of course that doesn't happen. We're not going to do that, except unless there's some root cause as to why we should be. And if we're going to do it, every other bank is going to do it, because we're all going to be in the same boat. In that case, you need to look not at what we did, but the root cause of why we did it. And there was a root cause of why we did it in 2007. Hands up, who knows what the root cause was? Well, you know, it was the rise in capital ratios. Because the words were, we can manage a balance sheet, but we can't time a capital market. What we needed to do was raise capital. As the central bank, or the authorities were raising the capital ratios, we had to all of us had to go out and find huge amounts of capital in a very disturbed market, which we weren't going to get. And you may remember all the kerfuffle about, you know, that's why Lloyd's ended up with the government, that's why NatWest ended up wholly with the government, and why Barclays ended up in the Middle East, raising capital. So these issues became absolutely central to the way in which we operated in the face of that exogenous shock to us, which was this rise in capital ratios. I'm not suggesting that banks shouldn't have had higher capital ratios. What I am suggesting is if you're going to do it, don't do it in one big bash, because as soon as you did that, don't lend anybody any money became everybody's cry, because you can't hold the balance sheet unless you've got the capital. The Financial Stability Committee's remit has gradually extended to cover MBFIs. There's a lot of MBFIs around, you may have noticed. I have some figures in, there's a much longer presentation of this, I have some figures in it which show you basically how banks have curtailed their lending over years into, so many of them these days look like large mortgage banks. And the way in which central banks have operated with these dual committees is, in my view, one of the big problems there. There isn't this communication between one and the other. And we haven't got a connection that understands how the banking system is going to react and why it's going to react. So that root cause analysis is missing. Nobody knows why we do things. It seems odd to me. It's fairly obvious why we do things. But anyway, one of the things that had happened in the US, which I think is actually a report really well worth reading when I was doing this, so I was looking at this, is basically this report by the Fed. Now it's about cyber risk. But it's fascinating to read because they actually did start taking apart the system dynamics. And when they did, they came to this conclusion. And it's huge. SVB's 250 billion. Yeah? Signature Bank was around just a bit short of 200, I think. And First Republic was somewhere around the same sort of size. So why did they jump in and do something they'd never done before? Right? And why I say never done before, because the Fed actually funded their holdings of mortgage-backed securities and their holdings of government bonds at their nominal values. Their nominal values. Not their market value. What central bank is on? If I'd have gone to the central bank and asked, could I have the money on the nominal value, I think they'd have laughed at me. Or thought I was insane and probably had me locked up and certainly lost the job. You know, who does that? Well, the answer is US authorities have, and they've done it for a very good reason. They had to stop a potential run on the banking system, and I think the reason they had to stop it was, in some ways, they were worried about the effects they'd found on that board. One of the things to remember about this is that, well, this is just a slide from an undergraduate course actually, but what it is showing you what happens if interest rates rise. How much do you lose in value? These are the banks that lost the most. But let's take a look at this one. Can everybody see? I'm going to have to walk out in front. I can't do it any other way. Can everybody see this one here? SVB. That is the amount of held to maturity securities, right? 43.1% of its balance sheet, of its entire assets. Go back to the slide before. Those have lost something like 20% of their value. Their market value is down about 20%. That's roughly 10% of the bank assets has lost. Yeah? Its capital is going to be, equity is going to be about 12%.
It actually wiped its entire...
It's gone. It's gone. It's disappeared. It's gone. That was the problem. And look at the spread of these, and they're not all small banks. You've got some really big ones in here with some huge losses. Indeed, if we go to this one, what we've got down here is, look who's down here. Bank of America, 20.7% of its asset base is in held to maturity securities. Now, held to maturity securities is nothing to do with regulation. Held to maturity securities is an accounting convention. These banks were being allowed to hold securities against an accounting standard. Not against a Basel standard. There's no risk in here. This isn't risk adjusted. There's no risk adjustment whatsoever. There's no interest rate risk in the banking book being managed. No visible signs of it whatsoever. What they're doing is holding them simply as they're not subject to Basel. All these banks, not Bank of America should be, but the others, were not subject to Basel. And this is the size of the losses. Now, whether you can see these numbers, you probably can. Held to maturity securities. Those are just being held at nominal value. They're the ones that have collapsed completely, but no, everybody's ignoring it. These ones are available for sale securities. They are expensed through capital, so they don't affect your P&L. Okay? They're not going through P&L, they're just going through capital. But it's a real lot. So the capital will be eroded by that. But the blue bars, they're not being eroded by that. There's no erosion of capital for those numbers. That's frightening. And that's why the central bank intervened. It was aggravated, of course, by there not being... it was aggravated, of course, by there not being insurance on amounts over 250. Over 250,000 in the US. 250,000 in the US, a lot more than in Europe. In Europe it's 100,000 euros, in the UK it's 80,000 pounds. US it was 250,000. The Fed guaranteed all deposits, full stop. No matter how big a deposit, it's all guaranteed. These are extraordinary actions. It always seems odd to me that Nobody seems to be investigating this very much. It's huge. And the problems of concentration risk in the way in which these banks were operating is also substantial. Where did it all come from? All those deposits, where did they all come from? A mass of capital raisings. Yeah? Money was zero. Money cost zero. Everybody went and raised tons and tons of capital and held it in the banks. What to do? Well, I'm not a revolutionary. I mean, that's one of the things, you learn to live with these systems. You learn to live with the system, not least because a system isn't just determined by what economists might like. Lawyers have a big say in it too, a very big say. And most of the problems, believe it or not, we have research groups that looked at things like narrow banking. We looked at things like what would happen if we split deposits off and made people actually conform to them, because certainly under UK law, and one of the things that we've always been very nervous about, okay, 2 minutes, is that we don't actually enforce any of that. If you want your deposit money back, you just go and get it back. We will penalise you on the interest, but you can have the money. Okay? And the reason was we never wanted to take that in front of an English court, because an English court would say, well, okay, what was the damage? What was the loss? What damages are you suing for? And the answer will be, well, in many instances, we made a profit. Because if you place the money with us for fixed 2 years at 3%, and you're halfway through it, and interest rates have risen to 5%, yeah, you have done very badly. We've done all right. So the problem, basically, is that we never wanted to take that in front of an English court. These contracts that banks have, and they're true of the lending, particularly when it gets to overdrafts, but it's general throughout the whole system, is that these are not hard contracts. This is not like when I was dealing in the dealing room. The first thing I learned, what are these contracts that we're dealing with? They're very woolly. They move around a lot. Yeah? I can't actually penalise people for taking their deposits away in the way in which I would. I can't market to market. They haven't got a clue what I'll be talking about. And no court would ever enforce it. So basically, there's a lot of things in there which are these retail contracts are very woolly things. It's not like dealing with a market contract. Anyway, my basic conclusions for all this is that we haven't really learnt all the lessons of these years, though I think we're beginning to understand just how connected the economy is, and it's connected because it's real. Financial system is connected, and it's connected because it's real. It actually is the way in which capitalism works. It has to experiment. It has to make losses, because if it doesn't make losses, it won't make profits. It has to take risk, because if you don't take risk, you don't get reward. Basically, the system is as it is, and you can see that with what I want to say straight here is, with a central bank or without a central bank, it didn't make that much difference. The only way of creating a more stable system, I think at the moment, one of the things I would be doing is I think I will go back to the way in which the Fed was first set up and ask myself, well, the things that we're learning, certainly from the last talk, hugely, is just how important money supply is. That was the first thing you were given control of. The other thing was the banking system. Why? Because the two are connected. So you need to bring those two together. You need a better understanding of the way in which the banking system fundamentally creates money. And that seems, and to deny this, or to go down these strange routes of sort of saying that it doesn't work, seems to me to be just nonsense. Of course it does. So one of the things I would say is that we need to bring them together. Understanding better and setting up a better monetary policy committee, whatever you want to call it, would involve not a focus on a narrow field of economics, a narrow view of economics, but two things. One is a much broader view of economics. Does money play a role? Can we have a few monetarists on this policy committee, please? Can we start an education process about the role of money, and that money does play a role in it, in inflation and nominal GDP output, but can we also look at the way in which getting you to understand better the way in which the banking system works? Very senior member of the Bank of England once sat in my office in Barclays and said, I said, oh, you know, we have these interesting conversations, but in a sense I always wonder why you come to my office for them. And he said, well, one of the reasons is that we're not really an actor in markets anymore, and we don't really understand how they work anymore. We're an observer. We observe what's going on, but we don't understand it from the inside. What I get from you is what's going on the inside. How are you operating? How are you operating with other banks? How are these markets evolving? And the other one that was really interesting that I thought we needed to do was, I was on the board of a Sharia bank, and various reasons, we were in the middle of the crisis, 2007, 2008, and the chief executive had left, various reasons, but left. And so the Bank of England said, who have you got who's going to take over? And everybody pointed at me and said, he'll do it. So I did it for a fortnight. It only took a fortnight. But it was in the middle of this crisis. And the Bank of England was monitoring us very carefully because they were extremely concerned. But as we held no government bonds, we held no securities at all. I held debt securities with Sharia Bank. We held equities. What would happen to our liquidity? We'd be devastated, wouldn't we? Well, actually, we weren't. Actually, what the surprise was, the equity markets held up far better than the debt market did. The debt market completely blew out. You couldn't get rid of mortgage-backed securities. Love the money. Mortgage-backed securities, because I had still plenty of friends in Barclays at the time, mortgage-backed securities that were trading at an expected loss rate of 10% of loss. Right? The banks held on to them, obviously. Outcome? 10 basis points of loss. So 100-fold difference in loss. That was the size of the way in which that market flew out. Now, I didn't like the prices we were getting for equities, but they weren't that bad. And so one of the things I would also say is that actually JP Morgan had something kind of right in 1907, was one of the things he did was try and bring institutions together and improve the price of equities. Not by changing the interest rates or whatever, because he couldn't do that, but what he did was actually consolidate the companies, lower costs, improve efficiency, etc. You can do that with equities. You can't do it with bonds. We've become fixated with one particular market, a risk-free market that is anything but risk-free, as that slide back there shows you. Not that one. Actually, it's that one. Because you can see the size of the losses that certain banks are taking. And they shocked me. Yeah, okay. They shocked me.